Hello, my name is Julia Dreblow, the founder of SRI Services and Fund EcoMarket, the free-to-use fund database tool for financial intermediaries. This presentation is one I was asked to create for a firm of IFAs, a network of IFAs, and I thought it would make sense to pop it online so that other advisors could make use of it, also having gone to the trouble of working out how to record these things. I hope you find this useful. On the final slide, you've got my contact details. If you have any questions, please do let me know. Thank you. So here we have the learning objectives, which are really two main areas. One is to understand what sustainable and responsible investment is. This area is also often called ESG. It used to previously be called ethical investment, but we'll touch on what we're talking about and what the different fund strategies are. And from there, we'll move on to looking at how you find out about what individual funds do, how you use the research, how you bring it into your everyday work. So I'll start by giving you some idea of who I am. So first of all, to say, I guess really I could be referred to as a retail SRI specialist. I've worked in this field for over 25 years. I now run my own business, which is called SRI Services, which has been going for around 10 years. Our main product is Fund EcoMarket, which is an online database tool, which has information on all the different retail funds that are available for financial advisors and other intermediaries. It's had around about 13,000 users over the last 12 months or so. We're running at about 12, 13, 1400 users a month on the site. In addition to that, I do consultancy and work with various partners. You'll be very familiar with some of them, for example, Rain Spencer Mills, Parmenion, Interactive Investor, PIMFA. I also do a lot of drum banging, I guess would be a fair description. Basically, I talk to people about this area, I try and explain it, and I will respond to consultations. I talk to regulators, I speak at events, I run events. I was at the PFS conference last year. I also work with an organisation called UCSIF, which I'm a main board member of, but I've helped them to understand retail markets for a number of years. Because there's a lot of people out there who don't understand the difference between retail and institutional, and it's really important that the message gets through that these individual funds have an important role to play. Why do I do all this? First of all, I believe it really matters where you invest. Investors shape the world around us, and we have some major issues. And the flip side to a lot of those issues is that there are opportunities. And I think it's important that we use investment as a means of helping to affect positive change. And also I think clients want that. There's so many people now who are positively looking for this kind of investment. So I help intermediaries to make that possible. But underlining all of this, I thoroughly believe it makes really sound financial sense to do this kind of investment because frankly the world is changing. The world is a different place and the direction of travel is very, very clear. Environmental, social, ethical issues are becoming increasingly important. So I mentioned that I started off in 1989. I was also SRI marketing manager at Friends Provident. You may have come across me there. I was there for 12 years running the SRI side there. And it would not be right of me to go past this slide without mentioning that the Fund EcoMarket tool I mentioned, which I will explain during today's presentation, is free to use because it is sponsored, supported by the 15 fund management firms above. So these guys make it possible for you to have free access to all the information that myself and my colleagues spend our time collecting on your behalf in order to improve the advice processes in this area. So I'm sure it will have come as no surprise to you when I said a moment ago that these issues are increasingly high profile and clients are increasingly aware and concerned and wanting to do something about it through their investment strategies. A great example of this recently, of course, is plastics, people's disapproval of single-use plastics. This statistic, for example, shows how dramatic the problem has become and illustrates why so many people now wish for us to move to a more circular economy where there's a lot less waste in the system. And then, of course, there's climate change. Now, climate change, I've been talking about for over 20 years. A lot of people fought against those of us that were seriously worried about it a long time ago. And the result is what we see today. We have a changing climate very clearly. Fires, floods, receding ice caps, storms, droughts. There are all sorts of issues which frankly could have been prevented. We didn't, and if we don't act now, they will get a whole lot worse. And so to current issues, no presentation will be complete these days without talking about coronavirus, COVID-19. I'm going to spend a couple of minutes just looking at it through a climate change lens. Clearly, coronavirus is a dreadful thing and we'd be very much better off without it. But from a climate change perspective, there are pros and cons, and I think they're worth understanding for a moment or discussing for a moment. On the unhelpful side, clearly, we were seeing really rapidly growing momentum, people understanding and making changes and trying to work through what was needing to happen in order to reduce carbon emissions and start to take real action on climate change. But we've seen the COP26 conference postponed, and we're seeing debt levels rising around the world, both in companies and in countries. So that's not going to help. Money that might otherwise have been spent greening economies or making changes to supply chains or technologies in companies that could have helped us to transition more rapidly to cleaner, greener methods of working and leading our lives, I would suspect may well take something of a knock in the immediate future as we come through the pandemic. However, there are one or two aspects also that I would argue may well be quite positive in the long term. People have started really thinking about supply chain issues and social issues. The S in ESG, environmental, social and governance, the S has always been, if you like, a little bit of a poor relation. Not so anymore. It's very front and centre at the moment as we're seeing how important it is that we look after people, staff within companies, those people who provide services who perhaps may have been overlooked in the past. There's also been a real recognition of our vulnerability. People don't normally like to admit this kind of thing, but realistically, coronavirus has shown up all sorts of issues that people had previously not understood or recognised. So from a climate change perspective, that helps us to recognise that we need to have complex solutions that solve multiple challenges. Solving climate change is not just a matter of flicking a switch somewhere. There's going to be things that need to change throughout supply chains, through investment methods, analysis, research, etc. And that's helped people to recognise that. And of course, people have enjoyed cleaner air recently. The number of people commenting on how much they're enjoying listening to birdsong, etc. will be a good thing, will help encourage people to focus more on these things when making investment decisions. And then there's areas like tax avoidance. I really think companies that have got very aggressive tax avoidance strategies in future will be far more under the spotlight than ever previously. And as we leave this slide, one thing I'd like to encourage you to do after this, your conference is over, is to have a look at the hashtag Build Back Better. It's really important. It's uplifting, it's positive, it's talking about the ways that we need to direct capital in ways that will help drive us towards cleaner, greener futures, rather than building back what we had before, which we know will have to change really quite rapidly. This slide helps us to look forwards a little and to understand why climate change is now such a major focus. At present, we're something like 1.1 degree above pre-industrial global temperature levels. We're aiming, as agreed within the Paris Climate Agreement, to keep global temperature increases below 1.5 degrees if we possibly can, certainly below the 2 degrees, which is the maximum limit set in 2015. However, where we're heading today, given that carbon emissions continue to increase, is somewhere between +3 and +4 degrees global temperature increases, at which point the financial services system we know today will have pretty much ceased to exist. Climate change will have played absolute havoc with what is and isn't insurable. Loans, the way banks operate, etc., will not be able to continue as we know them today. And this, of course, is why regulators and others are getting together and putting a major emphasis on what we need to do in order to hold global temperature increases down. So what's happening as a result? Well, basically, following the Paris Climate Agreement, there's been a lot more activity in this area. So end of 2015, you had the EU deciding that they were going to develop sustainable finance strategy. You've got the new EU Green Deal. We've got the fact that the UK and others have agreed to cut carbon emissions. The UK said we're going to do it by 2050 to go carbon neutral, or even net zero as it's often called. We've got an EU taxonomy that's been published to help people recognise what is and is not to be regarded as a sustainable activity. We've had the IA come out with a framework which is perfectly sensible. That was pretty recent. It helps to categorise funds and fund organisations and look at some of the activities that sit underneath it. You've had the FCA and the PRA getting together to create the to form the Climate and Financial Risk Forum. So banging heads together, thinking about what we can do, working together to reduce carbon emissions and to keep temperatures down below that 1.5 level that we've signed up to. The DWP has been making a lot of changes. They've been leading the way in many ways with regard to regulators in the UK. So changes to SIP requirements for trustees, ESMA, MiFID II in Europe, and the FCA is expecting to be part of this at some point in time, but we aren't expecting the retail side financial advisors to have to say what, or to ask clients whether or not they're interested in sustainable, responsible, ethical investment options, and to have processes behind that to make sure that the correct advice is given. We've had people like BlackRock coming out giving major statements saying that they're deeply committed to shifting investment to be more sustainable. Remains to be seen how that one plays out, but basically loads and loads of activity. The financial landscape is changing, I think, is all you need to know. And yes, at some point in time, it will become part of advisor requirements. Fund managers are having to do more reporting. And basically, there's a lot happening. This market will look very different within a couple of years. So let's start then by discussing where people can invest today and the different types of strategies that exist. So this is just a broad brush overview of everything, just to help you get into the market and understand what's what. First of all, let's start with the point that it really doesn't have to be complicated. There's lots and lots of jargon and people talking about labels. Yes, those labels have a part to play in helping to be more precise, but essentially you need to recognise that these are the main areas. With regards to the issues of concern, the things that people are worried about or that need sorting out, they break down into 4 areas. Environment, so that's issues like climate change, pollution, deforestation. People issues, social issues, things like human rights, labour standards, health, as I say, very much put under the microscope with COVID-19. And then there's governance, because without having the right kind of management structures in place, be it in a company, large or small, or any form of organisation, if you don't have the right governance structures in place, things can fall to pieces very quickly, which obviously is a problem all round, but certainly a problem for investors. So issues that you look at there is how companies are dealing with diversity, the wider pool of opinions you can gather as a company and different viewpoints, the more likely the company is to be better managed. And then there's areas like ensuring that companies have got bribery and corruption policies in place to make sure that they're not operating in ways that will put their business at risk. And then you've got the ethical issues as well. Of course, a lot of these funds started off being called ethical funds, and I know lots of IFAs still call them that today. But whatever terminology you use, the ethical issues that we're looking at really are those that are to do with personal values, things that individuals care about and that frankly different people can argue against. The 3 above there, ESG issues, I would say from an investment risk perspective, you can't really argue against wanting high standards there. Ethical issues, tobacco companies, armaments, animal testing, animal welfare, those are all issues that we will have personal views on. So a client may or may not be interested in those areas. So those are the broad issues, the things, the what side of the equation. The other side of the equation that people so often forget is the approaches side. It's very easy to assume that all funds ought to have the same approach. It's nonsense. It just doesn't work like that. So some funds will have strategies that are looking at avoidance. So let's just stay away from stuff we don't like. And there's different ways that people word that. Some will say they're excluding it. Some will say, well, it just doesn't fall within our remit of where we invest, so we don't hold it. Other funds will have then a more positive strategy, so they're looking at where they actively choose to hold, so positive stock selection strategies, themed approaches. Some may focus on impact. The impact side is, if you like, the icing on the cake, but it's really what this is all about, which is affecting change. But impact funds tend to be seen as being slightly different, but certainly the impact investors have is absolutely crucial on the backbone of what we're talking about here today. And then the third strategy is influence. Now, you can call it what you like. If you're thinking about it from a regulatory perspective, you're probably calling it stewardship or responsible ownership, perhaps. But what we're talking about there is engagement and using investors' relationships with the organisations they hold, they invest in, to try and encourage higher standards, to try and push them in the right direction and encourage them to transition towards lower carbon, towards better social standards, perhaps just to have better governance standards to ensure that the right checks and balances are in place. So 3 main approaches that can be taken there. And each of those break down in very different ways and applied in different combinations by different fund managers. But just keep those in mind, avoid, support or influence or engage. Those are relevant to pretty much all investments. So one way to help people understand the range of fund offerings that exists today is to take a look back in time and see how they've evolved over time. So the first strategy you'll be familiar with, ethical screening, as employed by the initial fund, the first fund that ever existed in this area, the Friends Provident Stewardship Fund, which is now split. It's owned by 2 different brands, if you like, so BMO and Aviva. Other examples of ethical funds that have come along since, some have been around a long time, some are newer. So funds like, say, Eden Tree, Kames, Rathbone, Unicorn, lots of funds still with ethical strategies embedded in them as being at the heart of what they do. Environmental funds came along only a couple of years after. So the first fund there really was the Jupiter Fund. Then along came sustainability towards the end of the century, the end of the last century. So sustainability really became a thing as people understood the planet being finite, etc. Funds that really focus on that kind of area today. Funds like Lion Trust funds, the Janus Henderson's funds, clear strategies in that area. Then you've got funds that focus on things like engagement, because engagement became a real thing again about 20 years ago, where shareholders started to recognise that they owned companies and they could actually encourage them to do better and therefore improve their chances of flourishing into the long term. So it was all about, if you like, enlightened self-interest, shareholders trying to encourage companies to do better. Along those lines, we've seen lots of companies involved in there. Responsible ownership now is a core part of this core strand of strategy for a lot of the players in this market and some beyond, alongside strategies like ESG integration, which 10 years or so ago, when it was starting out, was seen as something really special that some funds did to understand environmental, social and governance risks. Today, for a lot of the better companies, it's seen as, you know, a key strand to basically how you do risk management in investment across the board. And frankly, if a fund manager tells you that ESG isn't important, frankly, I would suggest you stay away. So then you've got funds like responsible ownership as well, strategies there. So there's quite a lot of funds now that are good at a number of different areas here. So people like Saracen, Pictet, where they've really got the strong engagement and ESG plus perhaps thematic plays or ethical plays, where they're integrating different strategies together to bring about products that can win on various fronts. And then you've got funds that focus on climate change, and one that springs to mind because of its name there is the Quilter Cheviot Fund. But of course, bear in mind that does more than climate change. That's got environmental strands and ethical and social strands also. And then we come on to funds like the impact funds. Now, it used to be called social impact, which was, I would say, fairly niche. It's grown. That what makes an impact fund different is the fact that it's focusing on outcomes and what it can help deliver. By putting money into particular companies, certain things can take place. So then there's quite a lot of focus on measurement of impacts and on explicitly looking to change things and improve things. So just a slightly different tilt from a lot of the other funds that we're starting to talk about here. And then, of course, you've got the whole sustainable finance agenda, which may well become the name that we start calling this whole area in due course, because frankly, with regulation set to behind it, sustainable finance is just going from strength to strength. Now this next slide I'm going to focus on for a few minutes because it's important. There are two axes here for a reason. The y-axis, if you like, is looking at where your client might be coming from, what your client's interested in, whereas the x-axis is looking at what funds actually do. So then, on the left-hand side, on the y-axis, we have got different motivations that different people have. Now, bear in mind, very often a client will be interested in all three of these, but at the end of the day, what we're trying to do is to come up with funds, or for you to come up with funds that actually suit what your client's looking for. So it's important to recognise that these are quite distinct. One area then is personal values, those things that a client cares about. They may be ethical or they may be environmental or social, but they are personal decisions, something that someone has decided, yes, I don't care what the business case is, this is just something that I want to do or not do. The next then is the business case aspect. Now we know the world's changing, we know that we've got to address climate change and that biodiversity loss can't be allowed to carry on. And we know that people are requiring higher labour standards and that some companies are going to be better able to deal with those changes than others. Some are leading the way, some are laggards. And so it's all focusing on the business case, how the world is changing and how companies are responding to those changes as they happen. And the third motivation that we have that people tend to look at is the degree to which they can have a positive impact. Now, I know people today talk about this as being a millennial thing, but I can tell you absolutely for sure that it started a long while before the millennials were investing, although clearly it's an area that millennials will ask about a lot more than others do today. So that is all about how we are using share ownership or other forms of investment ownership to help drive positive change, to help improve standards of sustainability or issues like supply chain management, carbon emissions, wide range of issues. So then looking back at the x-axis, what I've done here is brought together the groups that I use on Fund EcoMarket, which is the first group then of those funds that are looking at ethical issues, so the pure values-based issues, the bombs, booze and backy, if you like. Now those three, I really split into three groups. Sorry, those areas I split into three groups. Those groups are faith-based because there are a few funds out there, not very many, but are specifically designed for people of faith. They're not intended for other investors. They align to a particular set of values, and those are the clients that they'll be most suitable for. Whoever has that set of belief will be attracted to those funds. But by far the bigger groups then are what I call negative ethical and balanced ethical. Now the negative ethical ones are those funds that are just about avoiding stuff. There's not as many of those around as a proportion of the index, as a proportion of the market, as they used to be. It's really where the area was seen as starting off, although the very early funds always did in fact have positive aspects built into them as well. But anyway, so those are funds that really primarily what they do is exclude some stuff. On the balance side, it's those funds that are often given names like best in sector. And now they're taking a more pragmatic approach very often. So they're saying, guess what? The world's not perfect, business isn't perfect, there are pros and cons of where we invest. We have a set of requirements that a company must meet, and if a company is perhaps not doing all it could in a particular area, we will aim to encourage them through dialogue, through voting, and other forms of abilities to influence. But it's a more pragmatic approach, if you like, that will have the values built into it, and also it will lean on the business case. And some of those will focus on impact, some of those funds do not focus so much on impact. You've seen I've got the red, amber, green there to show you what the different strategies focus on most. The next set of three are what I call the more themed approaches, so sustainability, environmental and socially themed. Now, sustainability themed funds are those that focus on both environmental and social issues. So they bring together all the different sustainability issues and what changes need to be made in order to ensure that we're not damaging the planet for future generations, and to ensure that people can carry on having the lifestyles that they enjoy today, if not hopefully better. Environmental funds are those that focus very much primarily on environmental issues. So that can be a theme, it could be a resource, it could be a number of themes all brought in together. Any of these fund strategies will vary substantially. The third area then is social issues. Those are funds that focus on people issues. Now again, this is quite a new sector. There's only a handful of funds in this area, but there are funds where They will be a lot lighter on environmental issues because, frankly, their focus is social issues. The next two on the right-hand side are two areas I call ESG plus and responsible ownership. Now, ESG, we talked earlier about ESG integration being about risk mitigation. There are quite a lot of funds where that's largely what they do. They may use words like sustainability, but they're not actually picking up and focusing on solutions companies that are solving problems, and they're not necessarily focused tremendously on affecting change. But what they are doing is they're stripping out the risks. Now, on my database, I've decided not to list every fund that ever says anything on that now, because frankly, most fund managers are saying they're doing that. And I would say to a greater or lesser extent, they presumably are. I require funds to actually be doing something that differentiates them from the rest of the market, by which I would mean there would be some kind of strategy in there also that meant that they were focusing on positive outcomes and impacts, or excluding certain areas in addition to simply doing a bit of extra analysis on the risk side. And then responsible ownership is more about what happens on all of the assets within a particular company. So responsible ownership companies are those that vote their shares. They're probably PRI members. They are actively involved in driving higher standards, but what they're not doing is focusing on values and personal opinions. They're really very much focused on, well, what's the business case for change? What has to change in order for us to thrive going forwards? Because that will drive business success over the years to come. So as you see, the issues that a fund considers map differently across different client values. So when you're talking to a client, do try and get a feel for what they're interested in. Is it a personal value-led thing? Is it looking about financial performance and business solutions? Or is it really about trying to drive and support impact and encourage positive change? Because they map differently against different types of funds. So what I've done on this slide is to pull together some numbers for you to give you an idea of the different numbers of funds in each of the groups. So broadly speaking, what you will see obviously straight away is that sustainability themed funds now make up over half the market. So 62 funds which are sustainability themed according to my classifications, our classifications, but frankly mostly it's in the name of the fund. You can see that's what they're aiming to do, is focus on sustainability issues. There's still a good number of ethical funds around. There's a smaller cohort that focus just on negatives, a far larger cohort look at balancing pros and cons of different issues. And we've got also a good number of environmentally themed funds, and the funds I've classified as ESG plus tend to be funds where they talk about sustainability, but really they're looking at it from a risk mitigation perspective. So they'll be very, very, if you like, lightly screened, light touch, but they will be avoiding companies. Perhaps they may be tracking an index. They will be looking at reducing ESG risk and then probably bolting in one or two other strategies as well to make it a bit more interesting, so that it appeals to particular clients who've got a true and deep interest in something or another in this area. And then social themed funds, I said, are quite new. There's now 5 of them. A couple of years ago there were none, so that is a growing area. The focus on social impact has obviously driven an enthusiasm for that sector. So this brings us on to finding funds that match clients' needs, and really how you go about bringing this into your business. Whether you're looking at doing model portfolios or individual bespoke advice, the principles are the same. What you're looking to do is to have funds that match up to what a client wants and to meet their specific needs. And there are obviously many different ways you can do this, but I will talk you through what is available on our site on Fund EcoMarket. And I will start with talking you through an advice process. Now, I try not to be really specific, telling people what they should and shouldn't be doing as a process, because I've worked with many hundreds of advisors over the years, if not probably thousands. And no two advisors want to do things exactly the same way. But essentially the steps you have to go through is to understand initially who's interested. So is someone interested or aren't they in this area? So that can be a question in the main fact find, and frankly, given the regulatory changes we're expecting, should be an initial question at least in the main fact find. I would then suggest you go on to looking at the general areas that people are interested in. Now, you can use the Style Finder questionnaire on Fund EcoMarket for that, or you can have your own methods that you've set up for yourself. But broadly, you've got to find generally what someone's interested in. Are they investors looking to invest in line with their faith? Are they investors who are just interested in climate change? Is it the whole sustainability range they're interested in? Or is it perhaps just social issues? Maybe they've got upset about labour issues in particular countries or supply chain issues, and that really wants to be their area of focus. So try and find out the general areas that someone's interested in. And then you can move on to refining it a bit further, saying, well, okay, do you want to tell me what in particular you're interested in? It could be they've said they're interested in environmental issues and it's actually plastics that they're interested in, and climate change and maybe deforestation, or it could be labour supply chain, or they could get really upset about board diversity in different companies. You don't often hear clients really talking about governance issues most of the time, but every now and then when it's making the headlines, yeah, you will hear clients interested in that kind of thing. And then you get onto the stage of searching for relevant options. On Fund EcoMarket, you do that by just clicking search. Then you're recording your findings and you're building that in. You can use Fund EcoMarket for this or have your own systems to look at what asset types, geographic regions, basically build in the regular advice work that you would have to do in order to identify appropriate options that are suited to a client's risk profile and other needs that you've identified. So next off, to help you understand how to go about identifying those funds, I'm going to introduce Fund EcoMarket for you. So Fund EcoMarket was launched in 2010, 2011. It's been refined, shall we say, over a number of years. I have a bee in my bonnet for making sure this information is available to everybody. I want to help people to change the way they invest. The site is therefore free. It's designed absolutely for financial advisors. It's designed for intermediaries. However, it's open to everybody. I know journalists, regulators, students, etc. will use it. Absolutely fine. It's a reference tool for anybody who wants it. However, I do not deal direct with clients, with members of the public. I'm not authorised or regulated or frankly staffed up to do that. But the information is there for people to use as they wish. The way it works, however, is all designed around how financial advisors work. So you've got fact-finding support on there. You can search a fund by name, or you can go in and you can look at individual issues and themes, or different approaches, or corporate activity, so the responsible ownership stuff that happens behind the scenes. Or you can sift by product type, asset type, geographic region, or the SRI styles we've just gone through. It is designed to complement other tools, though. It's not designed to take the place of the tools that you already use. It's designed to complement them. The area I'm interested in, what I set out to do, is to fill in the gaps in the market and to help people understand how these funds work. It's a whole of market tool. All of the funds that I come across in this area go on the database, so they're all listed. I know that IFAs have to look at the whole market, so if I come across a new name, I will add it on. My colleagues will then send out questionnaires and we will put the research that they give us onto the tool. So it aims to be as comprehensive as possible. I know this tool will sink or swim, or continue to sink or swim, on the quality of the information on it. We do annual research going out to everybody, asking them to refill in our forms, but we do a look through of the market once a quarter to try and make sure that we're not missing any funds and to keep it as up to date as possible. So the tool is absolutely independent. It's run by my own business and it's entirely designed, as I say, around the IFA community, and it is also sponsored by 15 wonderful fund managers. These guys, some of them have been with me through thick and thin, getting it up and running, getting it working. What can I say? It has worked. We have around 1,200 unique users per month. I did a quick tally in preparing for this presentation. Turns out something like 13,000 unique users over the course of the last 12 months. That's lots and lots of clicks. There's around about 500 funds on the site. Something like 140 of them are OEIC or primary funds, and all the data for Fund EcoMarket sits in the primary fund entries. So be aware, if you select pensions or other sub funds, you won't have the full data there. You'll have to go back to if you like, the parent fund, the primary fund, to search full fund details and get the links through to fund manager sites, the right pages, etc. So let's talk for a moment about fact finding, because the most important part of this clearly is understanding what the client wants and what they're interested in. Now, I would say there's two main ways that you can fact find clients in this area. You've got a synaptics example here on the left hand side, which is a list of issues that you can tick to say someone's interested in that, and then you can go and research funds and work out which of those issues can be matched with funds and bring it all together. There are pros and cons to this approach. Firstly, clients tend to tick everything, and it's proven quite difficult for advisors over the years. But it is very thorough, and it gives you a proper audit trail for that kind of thing, which is obviously all important. Now, the one on the right-hand side then is Style Finder tool printout. So on Fund EcoMarket, what we have got is a questionnaire where we have indicator statements. People can select what they're interested in. And from that, there's an algorithm that sits behind those, which then basically matches the things that a client said they're generally interested in to the 8 SRI styles that I showed you earlier. So that gets you started. Now, after that, you've then got to start looking at the additional issues, which is where the approach the synaptics there have shown starts to come through. But I would suggest, given what we know today, with clients' propensity to say they'll tick everything on a list that's put in front of them, I would recommend you start with talking about the general styles or types of strategies that they may be most interested in. So you can start to whittle down the list. Let's face it, there's a lot more funds around now than there were in the 90s. So this has become more difficult on the one hand, but it's also become a larger market, so you're better able to suit clients' needs because there's so much more choice. So once you've understood the broad areas that clients are interested in, you then really should consider whether or not you need to go further and look at specifics. And on Fund EcoMarket, these are our three main filter areas. So you've got the policies, issues and themes box, which is the what side of things. So you may be able to see the 4 columns there: environmental, social, governance and ethical. There's a list of issues there. I do not include everything that exists on all funds. There are hundreds of different options that could be there, but there is a lot on the site. There's also a print off of them, which is available for you to download, which is on the site. You can just use it as you see fit to create your own fact find tools. The other two filters in approaches, which is around the how do funds consider things. So the first column there is the broad approach that they look at. Are they looking at balancing pros and cons of a particular company? Are they focusing on being a really strict ethical fund? Are they just limiting the number of companies that they would exclude? So some of the funds actually on Fund EcoMarket we've pulled out and put in to a limited exclusion category because frankly they're so close to being like regular funds that it's a concern to keep them in with them. So, but you can identify those funds because clearly there are clients who will only want to exclude a tiny fraction of the universe because they're just not that bothered, but they want to consider ESG issues from a risk mitigation perspective. And then you've got the corporate activity box, and if you look there, you can also see you've got hover over text. So on the Fund EcoMarket website, when you get to any of the buttons, there's just a brief sentence or so which gives you a little bit of extra information about what I mean by those different filter options, because I fully recognize that this is not everybody's bread and butter. You're not necessarily talking about this. You will soon get really good at it, but I've got those prompts there for you just to help you along the way. So you tick and you click the issues that you want, and once you've identified those things that a client's interested in, you click search and you come up with a list. Now this is just one example. What you will see here is that on the screen you've got some of the funds here which have got logos next to them and others that don't. The ones with logos next to them are those that are listed first, which are the funds that are belonging to those companies that are the sponsors of Fund EcoMarket, those that help me to stay in business, frankly, and help this to be free for you to use. But then after that, in exactly the same format, you have all the other funds which are not sponsored. So it's all there. I would not have it any other way. And then you've got reporting functions. So obviously for your audit trail, you need to have a lot of different information. So basically you type in your information, you generate your list, you click save, you produce a PDF, you use that on your records. You can either have the PDF saved with or without the full text and information. You may prefer just to have the names of the funds that are there. You can have that, or you can have the full text, which gives the full explanation. Now, as I said earlier, this information comes direct from fund managers. I'm not making this up. I've been in this area for a very long time, and I know fully well that once third parties start commenting on individual funds, they almost invariably get it wrong. They do not understand the thinking that goes on behind the funds, and they tend to get in a muddle. So for me, it's ultra important that you get this information direct from fund managers as they intend. Okay, so having told you about the many different variations and the support and information that's there, I think it's next worth focusing on for a moment on what good looks like, because there is more and more focus on this. And the absolute, well, the only important answer in many ways is that it's a fund that meets what a client's aims are. It's a fund that does, or funds that do, as the client wants. So if they think they're excluding something, they ought to be excluding it. If they want to be focusing on a particular area and helping to deliver positive impacts, then we want those impacts to be delivered. So matching a fund to what the client actually wants is clearly crucial. But in order to get to that position so that you know that's the case, you've got to be able to read up on what the purpose of the fund is, what their strategy is, what their aims are, what the policies are, what their approach is, and of course also performance. As I say, Fund EcoMarket doesn't carry information on performance or pricing or anything like that. There are other people that could do that far better and in far more detail than I do. But you've got to be able to understand what the fund is for, what its difference is from other funds, what the intentions of the fund manager are, and why they do what they do. And those will come through in the bullet points and the text on Fund EcoMarket. I'd also say it's absolutely crucial for a fund to be transparent and easy to understand. You'd be amazed how many fund managers today think it's a great idea just to say we follow such and such an index, and then that's where they leave you hanging. To me, that's not good enough. I want to know why a fund invests where it does, because otherwise it is a potential risk for any intermediary. I also like to see funds go beyond data. Data in this area has improved massively. There's lots of data around, which is really useful. But if a fund manager just thinks about this as being only data, very binary, black and white thinking, it scores 6.5, therefore it's better than something that scores 6.4. Sorry, no, none of that. I don't think that washes with clients. So I want to see explanations in words that you are able to take out to your clients and explain what a fund actually does. And of course, the last bit, the last bullet here, ideally we do want it to be shifting the dial. We do want funds to be actually making improvements, because frankly, that's where this area came from. It's what it's all about. And if it's not, if a fund isn't contributing to positive change, then frankly, something is wrong. A further point on that side then is around the lipstick on a pig bit. We have seen an awful lot of criticism of greenwash over recent months. Some people are coming very unstuck. I would say there are two groups of issues you need to look at here. One is those issues that are not necessarily of concern. So strategies are diverse. They should be. Clients' opinions are diverse, and their financial strategies need to be diverse. And sometimes people's wordings on policies, etc., aren't quite as clear as they could be. And sometimes it's maybe a little bit simple or a little bit irrelevant. Well, those aren't necessarily malicious. Whereas on the other side, things that are not remotely okay is where there's deliberately opaque product design, where it's absolutely impossible to get an idea of what makes a fund different. You can't find out how they vote. You can't work out where they invest or why they invest. They may be hugging a standard benchmark. If they're hugging a standard benchmark, chances are they're a pretty standard fund. A lot of people will overstate what they're doing in their communication, using words like sustainable or one of my favourites, do no harm. I'm sorry, most businesses today do harm of some kind or another. It's not a question of doing no harm, it's a question of direction of travel. And then some are strategically very dubious. There are areas where people talk about giving to charity, etc. Well, no, this isn't what these funds are about. These are investments. These are about making money. So it's what are we doing with the assets that we're holding that actually matters. So what next? I've mentioned that this area is diverse, dynamic, new funds launching all the time, new changes, new regulations, things shifting. The stuff that I'm involved in at the moment in my own business, as I say, I work with lots of other groups. I've developed a Fund EcoMarket app recently, which is coming online, I would say, about now. And another project I'm involved in is Dial Shifter, which is basically about not differentiating between different fund strategies as I do with SRI styles, but basically just giving funds the nod and saying, yes, this one is, in my view, something that is helping to shift the dial from brown to green. But I won't only be doing that for funds. I'll be doing that for intermediaries and also for advisors. So there will be a process that people have to submit an entry, and it will be independently verified, or verified by us first of all, and then externally verified. And people will either qualify or not qualify as being dial shifters in the club, if you like. I'm also running an event on the 21st of October, COVID-19 permitting. So I run an event annually. This will be at the Barbican. Goodness knows exactly how it's going to work this year. But anyway, please do sign up to it. It may have to go online. We'll see how that goes. But it will be an all-day event with all the fund managers I've talked about who work with me on Fund EcoMarket, plus a number of expert speakers. And yeah, sign up if you're interested. It's a whole day of submersion in this subject. So just briefly to recap on our learning objectives, I hope this session has given you a fair understanding of what sustainable and responsible investment is, and that you understand the background to it and why there's so many different fund strategies and really what they look like, and also that you've got a good idea now as to where you can go for information on this subject. We know clients are increasingly interested, we know there's a lot going on, we know it's very high profile, and that's what the services we offer are there to help with. There's a few areas I haven't had much time to touch on, things like what UCSIF do. There's a thing that happens, an event that happens every year called Good Money Week, which is organised by UCSIF, that you should take a look at. And there's going to be a campaign headed by Richard Curtis towards well, summer and autumn of this year, starting off, called Make My Money Matter. This area is increasingly under the spotlight. So with everything that's happening, I would encourage you to do some reading around the subject. There's lots of links to third-party sites on Fund EcoMarket, and I very much hope you find it useful. My final slide then is to give you my contact details, so please do get in touch. I very much enjoyed talking with people to go through and understand what questions you're getting from clients, so please get in touch anytime. My email address there is in the middle of the slide, and Fund EcoMarket SRI Services, our main web addresses. Also, please do sign up to our newsletter. That is how I will let you know about any changes that happen to events and any other news and activity that's happening. So all that remains for me to say is I hope you enjoy the rest of your day, the rest of this session, and I look forward to hopefully meeting you in person one day. Thank you. Bye-bye.